Good day, everyone, and welcome to another episode of Friar Financial's Financial Forum. So today we've got two sections for you: markets in motion, which kind of will entail and encapsulate just a high level read on what's going on in markets, and then we're going to get right into our wealth wisdom workshop, where this week we're talking about why taxes don't retire when you do. So last week, markets pulled back last week as investors rotated out of chip stocks and other high flying tech names, overshadowing the encouraging news we were having on inflation. So the S&P 500 actually fell 1.6%, the Nasdaq dropped 2.9%, and the Dow slipped another 0.9%. The week began with the renewed Middle East tensions, of course, and higher oil prices weighing on consumer sentiment. So while markets welcome reports showing both consumer and wholesale inflation unexpectedly declining in June, supporting hopes that inflation pressures are easing, selling in semiconductor stocks continue to pressure the broader market. So what does this mean for investors? Cooling inflation remains a positive development and could support future Federal Reserve rate cuts. However, last week's pullback highlights the importance of diversification as leadership in these sectors can shift very quickly away from concentrated areas of the market. So remember to stay diversified and pay attention to your sector rotations. All right, so in this week's Wealth Wisdom Workshop, we're going to talk about why taxes don't retire when you do. So, Jeffrey, one of the biggest surprises we see is that many people assume their taxes will automatically go down once they retire.
Yep, and unfortunately, that's not often the case. While your paycheck may stop, the IRS doesn't retire with you. So, in fact, retirement can introduce a whole new set of tax challenges that many people just don't see coming.
Yeah, so what's actually driving that?
So, several factors. Many retirees have built substantial balances in tax-deferred accounts like 401ks and IRAs. Eventually, the government requires those funds to come out through required minimum distributions, or RMDs, as we like to call them. And those withdrawals are taxed as ordinary income, whether you need the money or not.
Okay, so even if someone has enough income from other sources, they may still be forced to generate taxable income.
Exactly. So let's look at an example. Linda is 73 years old and has $1.2 million in a traditional IRA. Her first RMD is about $45,000. The challenge is that she only needs about $20,000 for living expenses. Yet she's still required to withdraw the larger amount and pay taxes on it.
So that extra income can create more problems than just a larger tax bill as well.
Yep, that's right. So one distribution could push her into a higher tax bracket, increase the amount of her Social Security benefits that are taxable, and potentially raise her Medicare premiums through IRMA surcharges. It's a domino effect that catches many retirees off guard.
So speaking of Social Security, many people still believe those benefits are tax free.
Yeah, unfortunately, that's another retirement myth. So depending on your income, up to 85% of your Social Security benefits can become taxable.
Can you give us another example of that?
Absolutely. So let's consider John and Maria. They receive $40,000 annually from Social Security, withdraw $30,000 from an IRA, and earn $5,000 in a municipal bond interest. So when IRS calculates the provisional income, they exceed the threshold that subjects them to taxation on up to 85% of their Social Security benefits.
So what they thought was tax free income becomes taxable simply because of how their other retirement income is structured.
Exactly. And that's why income planning matters just as much as investment planning in retirement.
Now you mentioned this, another area that's often overlooked, excuse me, is Medicare.
hmm Yeah. So specifically IRMA, the income related monthly adjustment amount. And I know I keep saying IRMA, but it's IRMAA. Think of it as a hidden tax on retirees. If your income rises above certain thresholds, your Medicare Part B and Part D premiums increase.
And even a one time event can create those higher costs.
It certainly can. So let's say Robert, this time age 67, sells appreciated stock and realizes a $50,000 capital gain. That gain pushes his income above an IRMA threshold. So the result is approximately $3,000 in additional Medicare costs between Part B and Part D premiums.
So that's a significant surprise for someone who thought they were simply rebalancing their portfolio.
Exactly. And it highlights why tax decisions should never be made in a vacuum.
So, beyond taxes themselves, retirees are also facing inflation and rising healthcare expenses.
Yeah, and that's another part of the conversation. So as prices rises, retirees often need to withdraw more money from their retirement accounts to maintain their lifestyle. So larger withdrawals mean higher taxable income, with which can trigger additional taxes and higher Medicaid premiums, like I just talked about. So
And healthcare can be one of the largest expenses that retirees face.
absolutely. So healthcare expenses can easily add up to hundreds of thousands of dollars throughout retirement. The longer you live, the longer you're exposed to inflation, tax rules, healthcare costs, and RMD requirements. Longevity is a wonderful thing, but it increases the importance of tax planning.
So, what can investors do today to help them prepare?
So the first step is awareness, kind of like we're doing right now. Too many people focus solely on accumulating assets without considering how they'll eventually withdraw those assets. We encourage clients to look at tax diversification, retirement income planning, Roth conversion strategies when appropriate, and ways to manage taxable income before RMDs begin, which is the key part.
In previous sessions, you also mentioned the health savings account as a valuable tool.
Yeah. HSAs are one of the few accounts that offer what many call a triple tax advantage: tax deductible contributions, tax deferred growth, and then tax free withdrawal for qualified medical expenses, of course. So retirees concerned about future healthcare costs, and HSA can be a powerful resource, and that's why we include it in a lot of our plans.
So, the lesson here is that retirement isn't just about replacing a paycheck, it's about managing income efficiently.
Exactly. I couldn't have said it better myself. Taxes don't disappear in retirement. They simply just change form. So the families who tend to have the most success are the ones who plan proactively and understand how withdrawals, Social Security, Medicare, and taxes all work together in unison.
Oh, that's a great takeaway. So, retirement planning
hmm
isn't just about how much you save, it's about how much you get to keep.
Exactly. 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 That's the name of the game. We want to preserve that wealth. We don't want to give it away. So yeah, and well said. And then I'm thinking the earlier you begin planning for those tax challenges, the more options you have to preserve your wealth and create a more confident retirement.
All right. So, that sums it up. Again, two things that we can manage in retirement is cost and taxes, and it comes
hmm
from diligent planning, getting ahead of the curve to know how these things interrelate with one another. All right,
Yeah.
so
We
this
want
was
people to
week two.
live as long as possible. So we want to plan for that too.
Absolutely, absolutely. So this was week two of
hmm
our eight concerns that pre-retirees and retirees face. So again, we'll be back next week with topic number three. Everyone have a great week. Thanks.